There we go.
There you go, done.
Okay. Welcome everybody. I'm hoping a few more lads get on and they're maybe trying to get in. I can't quite see them, but we'll let them in as they come along. Tonight we have a terrific fella. Been a good friend to Celine and I over the journey in our business careers and everything else, and more than that. To be fair, Zach McArthur is our one of our financial team based down in Launceston in Tassie. He's always good for a chat. He's very active in lots of ways, and I'm delighted to welcome young Zach tonight. So, Zach, good evening to you. How are you getting on?
Thank you, Mick. No, yeah, well, that was a cut down version, so well done. Thank you very
Oh
much for
no, I haven't actually started it yet, but I'll just give you the preamble.
that.
So, what I
You
will
got
do
more.
is I
Okay,
will
go.
now give you the official spiel that Zach wrote himself. So, just to take
Oh.
Zach is currently serving as Director and Financial Advisor at Intent Financial, a boutique financial planning firm with offices in Tasmania, Gold Coast, Camberwell, and Melbourne, and the Mornington Peninsula. His skills span across leadership, executive coaching, strategic planning, process design, financial analysis, change management, sales, and professional planning. Zach is known for his ability to lead teams, effectively drive productivity, and navigate through economic cycles. Zach holds a Bachelor of Commerce degree from the University of Tasmania, along with certifications in financial planning, and is a graduate of the Australian Institute of Company Directors. Zach has a strong commitment to community involvement. Yes, he does. He's very heavily community oriented and has held positions in varying sporting clubs and organisations. He's also achieved notable feeding sporting feats, including competing in marathons, Ironman triathlons, and other endurance events. Um, well, that's very impressive,
That's
Zach.
enough. Yes.
Very impressive. I can
Thank
say
you.
this, though, on a personal note, that when Celine and I started our business lives in 2020 down in Tassie, uh, we were advised by mentors of ours to find a financial and backing team. So as we went forward, we could have up-to-date advice from the best knowledge of people who knew and had our best interests at heart. And Zach, along with our accountant and Zach's buddy Richard down in Lunny, they have been part of that team for 20 something
Mm,
years now. And
mm,
it's been a
mm.
tremendous journey. It's been mostly good laughs. There's been some
Absolutely.
stern words every now and again, and lots of good advice on the way. So, Zach, very, very good evening to you. Thank you for your time tonight. I know you're not in Lonnie, you're in Coolum.
Yeah.
And thanks for jumping on.
No worries at all. And thanks, Mick, for giving me the opportunity. I mean, I think I love these sorts of sessions. I think the first thing though is to apologise for the late cancellation for the last one. Now that ended up being a 6-day flu or influenza A, which I absolutely have never ever had. Worse than COVID. It was ridiculous, absolutely ridiculous. So that's done. But I think tonight was more about just giving you guys and your team, your little community, some open generic advice. It's general advice in nature. My disclaimer. I need to get that on the recording now.
Yeah, yeah.
And Mick's got a copy of the presentation and also a special offer that we've opened up for the lads to certainly to hopefully build some of their own financial sort of fact finding and bits and pieces. But Mick, yeah, I think tonight was more about if hey Greg and anyone else is online, just certainly happy to take any questions. Happy to guide it in whichever direction that you like, and then certainly go through a bit of the process that we believe in and some of the sort of foundation questions and building blocks that we put in place to certainly secure people's financial future. Yeah, which is good. Bit
Yeah.
about Intend. Three of us got together and decided that we all liked each other. Three complementary skills: a guy called John Moran, Ben Buchanan, and myself. Launceston to Mornington Peninsula, and have now grown significantly. We have two other business partners, and as Mick said, there's an office in Robina and there's an office in, it's actually Hawthorn now, Mick. Not
All right.
so, but that's
Yeah.
fine. That was my mistake, and that's changed in the last 2 weeks. So let's move there. We have a foundation of holistic advice, and so we're not here to sell investment ideas or investment products. We take an approach that's and everyone should looking at everything And I think that's most important. Investment returns, go up and down, and but one of the foundation questions that we ask is, what are we actually heading? Where are we heading? What's the future look like, and what are we striving for? And that could be, I want to spend $100,000 a year on holidays, or it could be, I want to save every spare cent I've got for my retirement, and it's got to be at 50, not 65 or 67. So there's not one size fits all. It's very much a relationship model and a coaching and education model. And that's what we pride ourselves in. It's that. Now, I will also call out that I met Celine before I met Mick, and she has been a significant influence in my life, as has Mick. And certainly Celine's certainly educated and helped me with a lot of the coaching and mentoring foundations that I've got. So certainly a big call out for her as well, which I'm sure you all appreciate. You probably see the team of the Egan's have got that strong foundation of values and support. So that's a bit of a reminder too, Mick. The other day I was thinking about that as well. So Celine and I met a long time ago.
Yeah.
Now, I'll share my screen. Is that okay? Or can you actually open up the screen sharing there, Mick, if that's okay?
That's now, as you would know, Zach, technology is not one of my strong points. What do I need to hit, pal?
Well, I reckon I'm hitting share screen down the bottom, and it says host disabled attendance screen sharing. So I'm not sure what that means, but that's okay.
Whoa. Yeah, if I press the green share screen thing.
Yeah, what does it say?
It says share.
Yeah, that's what's on your screen. Yeah. You don't have a copy of that presentation then, do you? That I sent you earlier today on the PDF?
I think I have made a horse's collar of this, Zach.
So what we can do though, Mick, I'm really happy. I can speak to it.
You speak to it, and I'll figure out how.
Yeah. All right. Just to give me a share access or something like that. So I'm not sure as an organizer.
Well, there you go. Whatever I've done now, you're the big picture now. So knock yourselves out.
We have a pyramid, and the pyramid is fundamentally what we believe in, and our motto is for your whole life, and it's holistic. And with all good pyramids, as there may be some builders or some engineers in the crew, but that's the strongest shape that exists. If it's 60 degrees pyramid or triangle, then it holds in very high regard. Bridges are built, etc., etc. The three key blocks at the bottom for us, and our starting point for any conversations with anyone, is: do you understand your cash flow? Do you understand your expenses? Do you understand your income? And then ultimately, what is the surplus, or what is the loss? And we spend a lot of time identifying that. But we're not the people that say, hey, you need to stop buying a carton of beer a month or a week, or your Foxtel's got to go. It's more about saying, okay, so we need to find where you're at right now. We need to find out whether there is anything that you've got surplus in order to basically achieve some of your goals. And so some of the goals are certainly spoken at in an aspirational level early on. And then we have to proof it. We have to challenge it, and we have to truth it out. Just to make sure that what you're wanting to do is actually achievable, and we can help with making those dreams come true. And that's something that we do spend a fair bit of time with. And the simple thing is, we're challenging a lot of people at the moment, or just go through your bank balance, download the transactions for the last 3 to 6 months to get a trend. And then go through that and highlight the things that are not negotiable, i.e. your fixed costs. Hi, Ed. I think Ed looked like he's joined us.
Can I interrupt you there, Zach?
Go. Yeah, sure.
This is a welcome return to the lads call, because Ed has been preoccupied with something the last couple of months. Ed, did you want to fill everybody in, please?
Hey, Mick, thanks for that. So from the 23rd of July to the end of September, me and a mate of mine walked from Brisbane to Melbourne. It was a total of 2,800 kilometres all up, and we've raised just over $110,000 for a kids' cancer charity called Camp Quality.
Oh, fantastic, mate.
Well
Well
done, Ed.
Great
Awesome.
stuff, Ed. Well done, buddy.
When did that finish up, Ed? Just recently?
On Monday the 30th.
Right. Okay. How are you feeling?
Yeah, good. The body is weary, but in one piece,
Oh,
less one
nice.
toenail.
Is that all you lost? Oh, that's all right.
Yeah.
That's a win. That's
Yeah.
definitely a win. Yeah.
You've done well.
Fantastic. Well done, mate. Good job.
Okay.
Great charity too.
Thanks.
Yeah.
So sorry, Zach. I need to get in there to do that, but knock yourself out now, Zach. Where you go?
Awesome. Yeah. No. Well, once again, jump in. So I think it's easy to do. There's a bunch of budgeting, and I'll talk about one that we recommend in a minute. And by the way, Mick's got a copy of this presentation, which I've asked him to send out on behalf of us. So what I'm talking to here will resonate with you later on when you see the slides. But that budget surplus, it's identifying what's fixed, what's variable, what's luxury, what's not luxury, what could go, what could stay, and it's just these days it's as simple as downloading a transactions through the bank account. Very important. Then we try and articulate what level of capital do you need set aside to provide you with some comfort, i.e., emergency funds. Does that equal 1 year of expenditure? Does it equal 5 years of expenditure? It depends. Does it equal half a year's of expenditure? And things that vary there is, your job, your career, your job, your business, your financial backing, your level of comfort. And it's cash flow comfort. We use the word cash flow comfort. That's the next thing that we look at. The third thing, but these are all in the same playing field, but certainly very important. What do we need to protect? All right. What assets do we need to make sure are more cashable or supported if there's a significant event that occurs within a household, i.e., and we're not general insurance people. We're more wealth protection people. Do you have the life of the breadwinner protected in your family from a lump sum perspective? So they deceased, they have a long-term terminal illness, and so that asset, that ability to generate income for the parents or the spouses or the partners, we certainly make sure that we review that. I don't like insurance, and Mick and I have had some great discussions about insurances over the time. We hate paying premiums, but at certain stages in your economic, your life cycle, it's more important to have it. But it's it's a great day when you can cancel as well, because it means you've probably achieved your financial goals. But we've got to make sure that there's protection in place over your journey. It's a great, robust conversation, or you and your spouse or your partner understand what's going to happen if one of you is no longer around, as far as asset sales or a debt reduction strategy, et cetera, et cetera. So they're the three main things that underwrite our whole strategy. And we move up to the next level, and then we start to look at some of the planning aspects of financial advice. Probably the biggest one that we spend a lot of time on very early on, and I don't want to, please, only if you feel free, Ed and Greg that are online here at the moment. Who has a will? Put your hand up. Is that a hand up there, Greg?
No, it's a shake of the head.
Shake of the head. We spend a lot of time. We send some clients. We don't do work for clients traditionally. We send them to their solicitor first and foremost, which is quite cathartic. We had an interesting scenario probably about 12 months ago now, where we saw a client did some deep diving on their financial position. We didn't think we could help them too much, but we implored them to go and get their will. There were a couple that came together, second marriages. She had some kids, he didn't. She had more assets than him. And we got them to go get their wills done. And with the humblest and with the much I was sad in the end. One day I ran into him and she'd deceased. She passed away from a brain aneurysm, and but he was clear with what had to happen. They'd had the conversation, and if that hadn't happened under Tasmanian law with a split family, it would have been a very complicated arrangement. So yeah, we've got a war chest of those stories, and mostly they're more successful than not. So I'd implore you to go grab a solicitor, even if it's a basic will. If you die without a will in Tasmania, it's very complex. Even if you have a simple will that says, I'll leave everything to my partner or my kids, that's better than not having a will. So if I've asked you guys, if there's one thing to take away from tonight, go and get a will done. Yeah, so that's something that we make sure. We don't do them, that solicitors do them, but we make sure that people have them. Powers of attorney, so that someone has the right to sign on your behalf if you're incapacitated. That's a tricky one, which we've had the unfortunate scenarios where we've had to deal with someone's power attorney, but it wasn't quite what they thought it was, so it's been quite complicated. And we've had to actually help someone go to the guardianship board, their spouse, to get authority and approval to be able to sign on their behalf, which is a horrible, horrible scenario. To prove that you've got the capacity to sign on your spouse's behalf is quite a loss of dignity, to be fair, in a manner of respect. So there's a couple of things there that we want to make sure that we've ticked off and got in place. So please, gents, at least go and get one of those done. I often get asked about will kits. They are what they are. Lawyers love them because they can charge a fortune to unwind them or administer them. So it's a bit of a double-edged sword. You'd probably pay less to a lawyer to get a will done as opposed to the $5 or $20 you go to the news agency and get a will kit. So just a little bit of something we really are strong on, and we really implore people get done sort of sooner rather than later. Any questions so far, gents? Anything to throw at me? Or
I've just got a quick question about the wills. Yeah. This is going to sound silly now that I'm thinking of it in my head, but a will that's written outside of Tassie is still legal in Tassie. Yes, there won't be any dramas with that.
No. And look, it comes down, Mick, as well to where you're at. So it's hard if you've got assets in New South Wales and assets in Tasmania or assets in the UK, or the will's the guiding light. The individual state laws will deal with taxes or anything else that but so no, it's a good question, and it's okay. It's the guiding light. Do you want to ask a question at all, Ed, or any?
No, I've got a question too. If you do have a will or you get one done, how often should you review it or check it?
Good question. The first thing is we believe that they are a work in progress. It's nothing that's set and forget. Every year when you do a review, have you updated your will? Do you need to update your will? So significant changes. Your spouse or partner passes away. Your kids move from being under the age of 18 to over the age of 18. Your kids get involved in relationships that you probably don't really agree with, and you might want to protect the benefit that may go to that child from that friend, that partner. And so therefore you might need to add some other trusts into the will, because the share of that, your estate's to be locked away for the benefit of that individual, not for that relationship and things along those lines. An executor. So an executor is someone that you put in charge to administer your will. Might be a great friend today, but not a great friend in the future. Or they might have passed away as well. So if you need to update executors and things along those lines, they're a significant event. Or if anything of significant changes for you. So for example, you might buy a watch that you specifically want to gift to child number one. It's now you'd go to a lawyer. A lawyer might say just put it in as an appendix, or no, because you've got a split family, or the second child might argue, let's get a new will that says specifically this watch, this model, is to go to Zach or to Celine or someone. Do you know what I mean? So they're the things, but it should just be it should be updated when it feels like it needs to be updated. Does that answer your question, Ed?
Yeah, thanks. That's good.
Yep. But it's a significant significant issue. Yeah. So we just spend more time on it. next thing is we sort of then start to look at debt structures and where loans and mortgages exist, and whether they're tax effective loans, i.e. business related or income producing loans, or they're personal loans. And the number one rule is that let's get rid of any personal debt as soon as possible, and that is the highest rate first, then the second highest rate, and you work your way down. But we really want people to own their own home, and if there's any surplus cash flow, to really to get into that sooner rather than later, because that's just a massive impediment on growing your wealth if there's home loan, because it doesn't give you any tax effectiveness. Investment loans are good as long as your income that you've got coming in to support the loan can support it. The challenge we have there these days is the maximum tax benefit is if you earn over an income of over nearly $200,000. So the negative gearing strategies these days are really for the high income people, and so we just got to figure out where the debt exists, and then as the priority list, what do we need to do to knock it down? Credit cards and things along those lines. And whilst we can't recommend, we're not able to recommend mortgage products at all, we do work closely with mortgage brokers to sort of say, okay, well, give us your banking details, give us your debt, your loan statements. Let's get a health check on those, and to the extent that we're in the process of actually bringing in a mortgage broking business into our intend business, we understand the value of that significantly for the client relationship, and getting it turned over, getting it in the right space as soon as possible. So it's an important thing. It just takes cash flow away from the ability to build wealth in the long term. And we go through cycles where income's high, income's low, and therefore debt becomes an impediment, or it becomes it's just a good leverage point. So we work with that, but we make sure we understand what it is. Any questions about debt at all? No.
No, that's a great point, though, Zach, around the personal debt. I mean, you and I speak about this ad nauseum, all the bits and pieces that are going on.
Yes.
And, it's a terrific. It's a great bit of advice, and of course, when you get to your 60s now, things start to take on a deeper meaning. And the grandkids, with in terms of a will and the debt structure and that sort of stuff. So.
100%, Mick. Yeah, absolutely.
Great. It's a great idea. Great comment.
Yeah. And then we talk about, in the middle of this pyramid, you'll see on the second rung is something called retirement planning. And I don't know, it's a word that I don't use that often, and we probably need to change our little pyramid. But these days, it's financial freedom, and that to me is ultimately what we're here to help clients do. But that could be at 50 years of age, or it could be at 87 years of age. The definition of it in my mind is that you turn up to work one day because you want to, not because you have to. All right. Or you retire from work because you can, or you stop working because you can, and not retire. But and that's where we spend a lot of time, once we understand those foundations about what you've got, what your cash flow is, and get things protected, to then do a lot of modeling around, well, okay, this is what you've said you want to achieve. Our modeling, which is complex, as detailed, says that you'll achieve that goal by the time you're 55 if you do X, or it's going to be 85 because of your cash flow. So are you okay with that? And this is the truth. These are the hard conversations that we have with clients, to say your expectations are beyond your capacity, or your expectations are way inside your capacity. And then that drives ultimately investment decisions. Whether it's a term deposit strategy, or it's an international share strategy, or something in between, or a combination of the risk that people are willing to take, which is up the rung a couple of times. But we do all that planning to see whether it's achievable. And once again, we've got some outlandish goals and aspirations for some clients, and we get them to work a bit longer if we have to. But it's part of setting that expectation around goals and objectives, which is fantastic. And we use the old SMART goal setting process. I think you guys might be familiar. Specific, measurable, attainable, realistic, and timely. You know, that's the old SMART goal.
Yeah.
And we spend a lot of time with that, which is important. Any questions about the projections, or any question about retirement or financial freedom? Has anyone got a goal on that, or is it front of mind, back of mind?
Well, just a question for you, Zach, around, sort of what you should be planning. I know it's probably a very individual question, but as a general rule of thumb, what do you plan for a retirement wage?
Yeah. It is so subjective, Greg. It's not funny. So I have clients that have $500,000 of retirement capital who want to live off $80,000 a year. I've got clients with $1 or $2 million that are really happy with 50 grand a year. So do you know what I mean? It's really about, well, what's your lifestyle expectation? All right. Now, there are some stats out there that the government have compared. You know, the average, a comfortable retirement. Now, the comfortable retirement for a couple is, if you own your own home, is meant to be about $76,000 per annum, according to the Bureau of Stats. Okay, that's a comfortable retirement. To be fair, though, my happiest clients are 67 to 68 years of age, so age pension age. So they're getting about $42,000 a year from the government. They've got they've got a car, a nice house, and they've got superannuation of about $400,000. And they live off about 50 to 60 grand a year. So they take about 20 grand a year out of their super, plus the age pension, and they're the happiest people that I know. So, you know, it's, once again, you can be aspirational and want 10, 20, $40 million, or, you know, the system in Australia, and I'm not paid by anyone to say this, but our superannuation benefit is amazing. It is so supportive. Our social security system is amazingly supportive. Dare I say it, for the support of all Australians. And so, yeah, it's good to have about that $500,000 in super and age pension age. But that means you've got to work to 67. All right. So, so that's achievable. It comes back to your lifestyle, Greg. Yeah, and that's the simple question. Yeah. Do you want to jump in there, Ed?
Yeah, I just had a question on that in relation to like super. Could you foresee any situation where like government super wouldn't be assured?
So,
so I'm in defence and I've got a pretty decent super package, and it's with government. But you know, we've seen, I don't know, what would it take for the government to have to renege on that?
An insolvent country.
Okay.
Do you know what I mean? Yeah.
Yeah.
So the answer to that is
pretty secure,
it's pretty catastrophic. There is nothing more secure than the Commonwealth Super Scheme. Okay. Whether the interesting thing is, because it's called a defined benefit scheme. So are you still in the forces, Ed, or are you out of the forces?
Still in. I turned 50 this year, and I've been in for 32 years. So I've got pretty decent super.
Yeah, fantastic. Yeah. And so, I think that you've got two choices. Sorry to speak specifically. You either can take a lump sum and you potentially, pay some tax, and then you get the chance to do whatever you like with it, or you take a lifetime pension, I think, which will guarantee you X number of dollars, rising with inflation till you pass away, and then your spouse gets 65%, something along those lines, I think, if they're still around.
That's about right. Yeah.
Yep. That is guaranteed by the Australian government. That's the only one that's guaranteed by the Australian government. Tasmania, where I'm from, used to have something called the Retirement Benefits Fund, which is a defined benefit supported by the state government. The process there is that, the day you retire, they go to you say you're retired, they go to Treasury and say, Ed wants his money. So Treasury then takes the money out of the bank account, based on the multiple and then on the calculation, and gives the client the cash less the tax that hasn't been paid to the government along the way, or they go down an income stream. So, so once again, it depends on what sort of freedom and flexibility you want in retirement, or certainty. I think that's really the great thing with a common super or a defence force super. Yeah, absolutely.
Thanks for that.
Yeah, no worries. So yeah, so that's so yeah. Are you Can you access that early then, Ed? Are you under?
Yeah, I think that I can access my contributions on the day I retire,
Yep.
but the government contributions I can't access until, I think for me it's 60 because I have like warlike service, so it's slightly different. Yeah.
Yeah. Okay. Yeah. Yeah. No, that's individual to that fund. Yeah. Yeah. Fantastic. So that's cool. Yeah. So look, that's super. There's some other slides on super. The standard contributions are about 11.5% for of your salary. In the non-defence force com super patch, your super's only as good as the investments that you make within them. And there aren't any other super funds that are guaranteed. So, it's a system that's very supportive of building wealth in super, but there's nothing guaranteed about what your balance will be at the time that you retire. So one of the great things is it's a user-driven system in Australia, but that comes with risk and it comes with consequences, and that's what we're here to do. We're here to educate our clients around risk and making sure that that's the best it could possibly be. So that's the superannuation in a nutshell. Yeah.
Zach, is that something that you can do through your business? Is look at the individual super fund and what's on offer through products, and sort of tailor a plan for how to move the funds around inside the super depending on market. Yeah. Okay.
And also long-term goals. We're not traders, We're not traders. We build an asset allocation that is some psychometric testing done on it, so that there's individuals have a propensity to take on risk, and each individual's separate. That's our guiding light. And then around that, we then buy, we then build the portfolio around either managed funds, or depending on the size. Some people like direct shares, some people like term deposits, some people like bonds, and then it's reweighted. We're a buy and hold type of investor. Once again, time in the market, not timing the market, is really important. And if you're long-term hold and buy, you buy good stuff at the start, and you just manage around the fringes. Like we're selling a fair bit of our Aussie equities at the moment because we're at record high, because the asset allocation is way out of whack as far as the benchmark's concerned. Putting it into international bonds because they've not performed so well, with a lot of clients, generally speaking. So the answer is yes. We're agnostic to super funds. We've got we compare the pair each time. We've got a whole bunch of clients in Australian super, CBUS, Hester, Host Plus, as well as BT, Expand, IWF products. It's what suits the individual investor. Unfortunately, some of the industry funds don't come with the transparency that we like, so we like to know what we own, and that's one of our key sort of ladders in our pyramid of investment transparency. We understand who the manager is. We understand what their philosophy is. We understand why they've chosen certain stocks over other stocks, and they either suit the strategy for that client or they don't, and we don't include them. And we monitor them and manage them and manage around them. But we want you to know what you own, and that's really important, and that's something that sometimes the industry funds, these closed shops that don't let us look through them enough. But Australian Super does quite well. They allow us to look in the back end of what they're owning, and we feel comfortable with their philosophy. Yeah.
And just to confirm, Zach and his team are not, talk to you once a year type of merchants. You can drop in any time, drop them an email, drop them a chat.
Yep.
We've just had a meeting. We've probably had 2 or 3 meetings the last couple of months, and I think we're due for a chat next week as well. It's leaning on yourself, Zach. So
correct.
So they're never far away for a chat and some updates and some discussion around what to do going forward.
Yeah. Thanks, mate. That's good to remind us, because we're here to make sure that you don't make silly decisions at the end of the day, you know, and you know, we want you to be selling at the top and buying at the bottom, which is contrary to the way in which the social medias of the world work, you know. And so we're here to make sure that you stay the truth. We remind you of what your goals are, remind you of what you feel is important. We have a lot of clients move from, you know, having 60% growth and 40% defensive assets to 80-20 or 85-15 when the market's charging along. We go, hey, remember, you know, what happens? And then at the bottom of the markets, they want to go from 80% or 60% to, you know, 30% growth. So we're here to say, hey, stay the course. We own good assets. We know what we own. It's about making sure we coach and educate them through each of the cycles, because we can't control that. We can't control that at all. Yeah. Steady the returns, or, you know, alleviate the highs and lows, you know, minimize the highs and lows. That's the cool. Cash flow and banking structures. So we know what your cash flow, where your cash flow goes and where your banks are. So that's one of our outcomes. We then, investment transparency. We use a lot of independent research. We've got, as I said, agnostic to platforms and to product providers. We're not aligned with anybody. We're a fee-for-service business, so we don't take commissions. We take commissions out of insurance because that's how the industry works. But, you know, we set a fixed fee. It's not an asset under management fee. It's a fixed fee to our clients based on what they need. And so, you know, that's really important to understand as well. And then we either have portfolios that are set for growth, which we don't really need too much income from in the accumulation stage, or we have portfolios that are built to provide that steady earnings, dividends, distributions that are going to grow over time. You know, and once again, that's just one of our key requirements. That's what financial freedom is. It's having money drop in your bank for, you know, for not doing anything for it, if you know what I mean. You've done all the hard work. Yeah. Ultimately, we want you to be financially independent. That's what we're here for. So, you know, at the end of the day, you know, to live the lifestyle that you desire, and it's led and driven by yourselves, you know, and that's what we're here to do. One of the things that we do, and Mick will attest to this, is we educate, and sometimes we don't move forward if we don't feel the client understands exactly what we're asking them to do or we're suggesting they do. And that's not only a code of ethics thing, but it's also been my mantra from day one. You know, we don't need you to understand everything, but you need to know a fair bit about the why, in order for us to feel comfortable that you're making a decision that's appropriate. Mick, you probably haven't been in the office for a while, but our office is designed that way. We sit around a coffee table. We're in some comfy chairs. We don't sit around a boardroom. We've got the screen, we've got whiteboards, we've got fact sheets. We do what's required to provide comfort. We can spend 5 minutes, or we can spend 5 hours, you know, in a meeting at certain times and stages through everyone's cycle with us. Absolutely, yeah. So that's the intend pyramid, I reckon, Mick, doesn't it? I reckon that's what it looks like in many respects.
I was just looking at the one on the original thing you sent me, so it's kind of similar.
Yeah, that's it. Exactly right.
I've got a couple of questions for you, and then the lads can jump in.
Yeah, go.
Trends. Is there anything that you're seeing now that, you know, normal people like myself might just want to keep an eye on, or are we? Yeah, you know.
Look, I think if we get it, we could have 3 hours, and I'd love these conversations. But you know, there are so we are in a transition from a global perspective, and Mick and I have had some great chats around these things that Mick picks up on in the past, haven't we, mate? But you can't be too complacent, and so what we are definitely looking at the moment is a lot of there's a product style out there called an exchange traded fund, or an ETF. You know, they are there. What that's enabled us to do, and they're brand new, they're probably 2 or 3 or maybe 4 years old now, but they've enabled us to get into access markets on a global scale that we would never have got to at a very low cost. And so a lot of our core portfolios now, so our stock standard Aussie blue chip shares, international blue chip shares, property, are now adding in some thematics because we can with these ETFs. And so some of the themes that we're really keen on is battery tech and lithium, global cybersecurity, and robotics and AI. All right, and so these exchange traded funds get added predominantly into our international exposure because we don't have these companies in Australia, you know, they are there to provide probably volatile returns, but they are the next. That's the next generation, and I'm not sure whether any of you guys are, you know, are interested or are read widely in the markets, but you know, GE was the largest company in the world probably 20 years ago, and GE is not even in the S&P 500 anymore. You know, it's no longer there because of the trend and the changes of how the indexes have evolved with the companies and the technology and things along those lines. So, so Mick, that's a trend. You know,
Yeah.
The other thing that's really important to know is there's always a geopolitical hotspot on this beautiful world that we live in. You know, it is always there's always one there, and so I don't know, and I don't need me to be disrespectful here, but I haven't heard much about Ukraine in the last 3 or 4 weeks because of, you know, Israel, Hamas, and the Middle East. You know, now I do know though that the Russians and the Ukrainians are still fighting a war, but it's this trend. You know, the noise that goes around the world is horrible. And it's so distracting, you know, and I'm, you know, I'm not, the crisis that exists in those countries is real and horrible. But from an investment perspective, what we have to do is we have to be a little bit more agnostic to some of those events, take that global picture view, invest in good companies that will get through cycles, understand the short-term socio-economic risks. But we can't be drained by them. You know, I had a client last night and he said, "Oh, what's my portfolio going to look like if World War III starts?" And I said, "Well, I don't know. We won't be probably having this chat, so I might not have a job. So, but I don't know. You know, we don't know. You know, and it's not. Yeah. It's a very catastrophic event." You know, Mick, the other thing that we do get asked a bit about, and I'm still learning this, and I'm honest with this, is that it's the cryptos and it's the Bitcoin.
That was my next question.
I knew you were going to ask. I thought I'd better jump in quickly. I feel they have a place. I don't know how and where they sit, but to the credit of the Australian market, there are ETFs now that are cryptocurrency ETFs. So we've just got to let them do their time before the research houses give us the tick to say this is okay. We've done our due diligence, you know, and we can add them into the portfolios in some way, shape, or form. All right.
Yeah.
And there's a strong argument that they will provide, you know, returns. They're not just a currency trading exploit anymore. But we've got to understand why and how they exist, because, you know, once again, losing money because things have disappeared, as opposed to a mine going defunct and running out of an oil seam or a coal seam, and it's failing. They're two different things, you know. We know why that one we understand, you know, okay, it was exploratory, it failed. And so there's a bit of that that's still got to come, and it'll only take time. But once again, Mick, this is not advice. I have ventured into some crypto just to try and understand it myself. So that's not advice. That's just me trying to educate myself as well. So I have no idea.
I've dabbled in it as well and dropped a few bob on it just to see how it works.
Yeah.
And I've sort of dipped in and out of it. I've had a good look at it the last week with I have an account on CoinSpot and one with
some Bitcoin.
So Bitcoin, but I mean, honest to God, I wouldn't have a clue. I just threw a few bob at a few of these things, just kept an eye on them.
Because the name looked good.
They look good. Actually, you get to name your own, and I named one of mine Leeds United just for the hell of it. So, and it's not doing particularly well. And the other one is Lobster, which is another sort of a lumens and some of that stuff I don't understand. I'm not the sharpest tool in the shed. So things I can see and touch property, you know, metals and all sort of things. I like all of that. So
correct, yeah.
But
and
that was my next thing.
So, Mick, just quickly on that one, it's all right to go to gold in times of crisis, but
Yeah.
we also believe you're better off to buy the gold miner than the gold nugget.
Yeah.
Now that's because we want income generation. So you're better off to buy a gold miner that's going to pay you a dividend than an ingot that's going to sit there dormant. And effectively, gold is a hedge. It's just a US dollar hedge, to be fair, in Australia. So you're buying US dollars when you buy an ingot of gold. So that's where we kind of don't do too much of that. We'd buy gold miners if we wanted to hedge against gold or inflation. Yeah.
Well, I think some of our strategy, Zach, is we do have some gold in that regard. So I do have some physical gold as well, not a huge amount.
Yep.
Just enough to go and buy a round of drinks somewhere if I need to at some point in time in the future.
Exactly. The other trend, which sorry to jump in. So the last one, sorry, Mick. Inflation.
Yeah.
Okay. And so there's no doubt the cost of living is extreme, and we're at the precipice of a change, no doubt. I feel that we certainly won't see. I have a high conviction. I won't say we won't. High conviction that won't be any more interest rate rises.
Mm.
And I think the RBA will be smart enough to say if there's a continual escalation in violence in the Middle East and the Russian and the oil price continues to go through the roof, if they cut oil fields out, that will cause inflation. And that's why we have this inflation spike to start with. It was a bit of that Russian oil that got cut off back in the 2 years ago or 12 months. Yeah, 2 years ago now. So that is a catalyst that you need to be aware of from an inflation perspective. Inflation in Australia is out of our control. We're just a price taker on most things, which is frustrating because a lot of us are hamstrung by that. Interest rates will go sideways, and so therefore we are moving out of term deposits into bonds because bonds rise when interest rates fall. That's another education. The value of a bond rises when interest rates fall, and so there's a bit of an arbitrage in that space for us as well. So they're the themes. If that helps, Mick.
Yeah. Ed and Greg, any commentary over the last 5 minutes of
ramble
that, about cryptos, about trends, about golds, about geopolitical stuff?
I got a question. You're talking about catastrophic events, and sometimes they're really hard to predict. Obviously, is there a way that you can, I guess, brace your portfolio to weather the storm as best it can, kind of thing? I mean, diversity's obviously got to be part of it, but are there any other tips or tricks that you can sort of implement to?
Oh, look, Ed, you could. There's one guy in Launceston, and Mick. I'm not sure whether you've ever come across Tony Gray at all. He's the only advisor that I know that he deals with sophisticated investors. So that's $2.5 million and above. He has option strategies over their portfolios, but he probably has 100 clients, and he can probably manage that around. You can buy options, you can buy puts. It's an expensive and a hard strategy to actually work through. The best advice I can give you is get the portfolio set early on, Ed. Understand what your appetite for risk is, whether you want 100% in growth assets or something less than, and the other side of the equation is defensive assets like fixed interest and cash. I have never sold everything at the top of the market and never sold anything at the bottom or bought everything at the bottom of the market. But I did sell one client out at the bottom of the GFC because he said, Zach, I can't sleep at night. And that's the only person that's convinced me that I had to do something for him. 3 weeks later, he said, I think I've made the wrong decision, haven't I? I said, well, no, you did. You made a decision that suited you. All right. You just have to be in for the long term, Ed. I think that's the other important thing. So don't start too late. We've all got life expectancies of 86 years of age as the blokes sitting here. That's our average life expectancy at the moment. So retiring at 60 is a generation. You've got 26 years to make things work. So you can't put everything in the bank either. And term deposits, you've got to continue to invest and go through the cycles of ups and downs. So diversify and look to the long term, Ed. Stick with your strategy. Don't buy too much of one stock, that you don't really understand. All right. So the bets on, Afterpay was a classic. I don't know whether anyone got involved with Afterpay. Went through the roof. Regulations changed. COVID hit, and then bang, the stock capitulated. People made a lot of money out of that. People lost a lot of money out of that because most people bought at the top. So don't go after a stock that's going to shoot the lights out, or put too much of your portfolio in it. Does that make sense? Don't overweight to a single idea. Overweight to a single asset class, and make sure that that's diversified. And buying an index does a bit of that. We buy indexes, and we have a couple of funds like the themes that sort of provide some science around their selections, where the index just buys all the stocks in the index at their market weight, and provides us with that buffer of if one or two of them fail out of 1,000 stocks, doesn't matter, does it? So just look for the long term and just get it set early on. Buy the portfolio well at the start.
Yeah.
Zach, I've got one for you just around housing.
Mm-hmm.
The crystal ball question. Australian housing prices.
Yep.
Are we exceeding what they are worth? I know that people are paying what they're paying for them, but are we likely to see any sort of reversal, or is this just part of the upward cycle?
Oh, look, the thing that's driving at the moment is immigration. All right, we bring in 250,000 people each year, and there's a supply. So at the moment, there's a supply issue, right? Lack of supply, which pushes the housing prices up. But if interest rates continue to stay this high for this long, Greg, and then unemployment starts to rise, then there'll be forced sales. The banks will be foreclosing on people to say, we haven't paid your mortgage for 6 months, we're going to sell your place. Remember, banks only want to actually grab what they're owed. Right? They don't care what the market price is. They just want to get it sold quickly. They owe us $500,000, might be $1 million place, because they've got to give the difference to the person that they've actually just foreclosed on. Do you know what I mean? So they just want $500,000 to get the debt paid to move on. So that will be a catalyst for change. Now, my partner's in Mornington. I don't know if anyone's in Victoria, but everyone's leaving Victoria at the moment because the state's in rack and ruin. So there's a definite decline in house prices in Victoria. All right, and there's we have gone. So the effective interest rate today at 6.5% is equivalent to the 18 and 19 and 20% that our fathers, our parents potentially experienced back in the late 80s.
And Mick.
Mick, yeah, absolutely. But the difference is that we are now, I think the mortgage is, it was maybe the average income was about 1 to 2 times the mortgage back then. Where now, the mortgage was 1 to 2 times earnings or cash flow or salary. Now it's 4 to 5. So you can see that it's unaffordable, Greg. And when banks only lend at 30% of your pre-tax income as serviceability, then something's going to change, and it can't last forever. All right, but until supply comes on, we're stuck at this overpriced asset in a technical sense for the foreseeable future, unfortunately. Yeah. Hi, Simon.
The back half of that question, was that looking to buy. We've obviously just finished traveling. Looking to buy in the next year or so.
Yep.
Without actually knowing my specific circumstances, strategies around buying property. Should it be for a domestic house where the family to live in, or a investment property, then renting?
Depends.
Okay, I thought you'd say that. Right.
But I think the questions that I would challenge anyone who asks me that question is that, do you want safety and security for your family, or do you want an opportunity for an investment portfolio? Now, if the rent you're getting from the property that you've bought is greater than the rent you're paying in your own home loan after your loan repayments, your own home, do you know what I mean? So if you're ahead on the rent you're paying, that you're paying as opposed to the rent that you're receiving after tax and after costs and then you kind of sit back and go, well, okay, we're in a profit situation. But guess what? That landlord could turf you out in 12 months' time. I'm going to sell, or I'm moving in myself. So it comes back to the personal security issue. But I think the other trend is that home ownership, I don't know, but I'm having a lot of conversation with older people to say, well, you've got this equity in your house, go and rent, as opposed to buying another house, because you can't do anything, So there's a flip side to that conversation as well. Some of the older people get into a retirement village earlier, it's secure and you've got that cash to, not aged care, retirement village, because you can access capital, that you've got in your house. That's too big. The government, by the way, too, Greg, on the housing, they've got this thing called a downsizer contribution, which means you can put up to $300,000 each into super from the age of 55 onwards if you sell your principal residence. All right. Now, that's a big contribution. It sits outside of all the other contribution rules. And so the government are trying to incentivize that couple that are rambling around the 4-bedroom house, that the family that's in the 4-bedroom unit can possibly afford to get into that house, but they haven't been able to get into it because it's not there. They're trying to shift the market a little bit. So those people are going to go to that 2-bedroom unit and get rid of it. So they're trying to shift the marketplace a little bit with it. It's a fantastic solution, but it's not doing enough. It's not generating enough of a transfer or a flow or an oversupply within the property market, which is a bit challenging. Yeah. But depends.
Just very quickly.
Out of time, aren't we, Mick? By the way.
Well, close enough. I just got one very quick question.
Mm-hmm.
You mentioned about retirement homes or retirement villages or retirement whatever it was.
Yeah.
Do you have an opinion, or is there types of those things to avoid, or is there schemes around it to actually have a good look at before you commit it? If somebody has an elderly parent, or God forbid, Slane and I, the kids turf us into one of them ourselves, so I think.
I'm already having those conversations with your children, Mick. So it's okay. We've taken care of it. So don't worry about it.
Thanks very much. But is there things, because you hear some horror stories about people having to commit a ton of money up to get into it and to maintain it and all of that, and can't sell it, those sort of things.
Yeah, so you're right. There's this transition from the over 50s villages, and I've just had a client that's moved into one down in Maroochydore, sorry. Yeah. Sorry, Mooloolaba. And they love it. They've made well in their property. They've got this secure environment now. They jump in their camper van, and they run around the countryside. The answer is do your research. That's different to a nursing home. All right, the nursing home is going to ask you for a refundable accommodation deposit, and that refundable accommodation deposit depends on the style of unit, house, room that you want. The change that occurred a few years ago is that comes back to the estate. Once probate's there, it's probably more about getting in early on a list so that you're in a place that you feel comfortable with. And each institution is different. There's been a raft of changes that have come through the aged care in the last 3 or 4 months as well. To be fair, I haven't had it's kind of a hit and miss with us in our business. We wait for clients to come, and they're normally talking about their parents. So then we get involved with it. I haven't had one with the new rules. But once again, they're just trying to make it affordable and for the right people to pay and the wrong people to not pay. Do you know what I mean? But do your research. Yeah.
Right. Look, Zach, thanks very much. I know it's been an hour, and we can talk about all this stuff ad nauseum for days and weeks and those sort of things. Simon, welcome. We are running late, but we will stick the recording it. We will stick it up into the lads group. I'm not sure if you're a member of that lads group, but we can get you onto that group, and you can view the whole recording from start to finish and all the topics ensued. Okay.
Yeah.
Thanks very much.
No problem.
Now, can I just on close, Mick? Gents, thank you as well for taking the time out to certainly have a conversation that we're very passionate about, and we want to make sure people, start with getting themselves sorted out. There is an offer at the end of the presentation. There's something called the My Wealth Report. It's a portal that we've developed, which is quite good. I've got a special coupon for you guys to go in and use if you want to. It's more about I guess, just getting everything onto a page, seeing where you're at. You can tick a button that says, I don't want Zach to look at it, or I'd like Zach to call me. You know, it says there's no impost, there's no requirement. It's just a little tool that we're sharing with these sorts of presentations to say, hey, if you can take some value out of what we've said and also have a bit of a consolidation of your own finances, then we feel you're starting on the right path. And if you want some help, sing out. There's no obligation whatsoever to do that. But once again, Mick, thank you for having me. And thanks, gents, for being on.
Absolutely, our pleasure, Zach. Thank you for coming on. You are, you're certainly well respected and knowledgeable in the field that you're in. And Celine and I, have no issue at all recommending you or your team to anybody, because I know you've looked after us the last 20 odd years, whatever it might be, and I know there's been some tough conversations, but they've been
good fun.
At the centre of that has been our best interest, and that's what we've always liked about it. So,
yeah, 100%. Yep.
Okay, gentlemen, I will stop recording this now. I will put this recording when I get it tomorrow into the lads call. I will shoot the gear that Zach sent to me into the lads group tonight. Fantastic. And at your leisure, have a good look at it and do what you need to do. And I'll leave you and Zach sort yourselves out in that regard.
Yep.
Okay.
Thanks, mate. Thanks, everyone.
Zach, Ed, Greg, Simon. Good night, boys. Thanks very, very much.
Night, Mick. Night, Zach. Thanks a lot.
See you, lads.
Cheers. Bye.
Stop recording.